let's bring in for WJB Capital Group. He's all chart. He's all moving average. He's got very cool blended indices. John Roque, good to have you here, sir.
Hey, Tom. Thanks for having me.
Yeah, it's good to be here. Let's bring up a chart right away. Here's agriculture over here on the 103. And you can see agriculture spikes higher. And when we mean spike, we mean a spike. Over on the right side of the chart there, Matthew, the camera guy, you can see that big spike. What do you do with a spike in technical analysis?
Well, Tom, the spike is a little bit unnerving, right, because it happens so quickly. Normally you get some sort of pullback in prices, but we think what's more important is sort of the big base that's been built for this index that goes all the way back over the last few years. You can see where it finally broke out in 2007. So we think that's actually more important than what's gone on over the last few weeks. What's gone on prior to this was leading up to what's gone on recently.
That big spike, Matthew, get back over on that chart. I'm making Matthew, the camera guy, work here extra hard today. In 08, remember rice, and this was serious stuff.
Correct.
Right, this was an IMF issue.
Correct.
Big food change. When you adjust for inflation, that's been quiet for 8, 9, 10 years in agriculture.
Well, it's actually been quiet for 30-plus years in agriculture, and we think what we're seeing now are the hints of higher agricultural prices going forward. We built our own farm machinery index, we built our own fertilizer index, and the prices there are reflecting some big changes.
WJB Capital, folks, they have like proprietary secret sauce indices. Tell me about your farm machinery index.
We have a few stocks in there, namely Deere, CNH, which is the old Case New Holland, AGCO, Lindsay Corporation, and Tractor Supply.
Did you buy them here?
All stocks look good to us. The better ones right here are CNH, Lindsay, and Deere. Deere far and away better than the others.
So you don't worry about that spike coming back down?
It can come back down, Tom, but I don't necessarily think that trying to get the next tick right is the real trade. Getting the next 20 or 30% right is the real trade. And if I am wrong for the first 2 or 3%, I'm willing to do that because I think that the higher prices are going to be out there for not only the ags but the equity prices.
Here's a Warren Buffett chart. It's not what he bought, but it's good enough. Union Pacific, railroads higher. You singled this out in your research report. I mean, for people trying to get their retirement plans to recover, you can do worse than the railroads.
The rails are in very good shape. Union Pacific being a leader, Norfolk Southern is another really good one. We like the rails a lot here, and we think that, you know, part of them doing better is likely driven by sort of commodity and agricultural transportation.
And now, folks, it's an emotional Columbus Day. It's Explain This. We're going to explain this. Once and for all, explain why you use a 200-day moving average.
Tom, 200 days is roughly 1 calendar year worth of trading.
20 days a month, roughly.
Something like that, right? Exactly. So that's the way we try to use it. And what's important to us, Tom, is the slope of that moving average, not the crossovers. So if you are buying an item or a stock, an index, an ETF that is above an upward sloping 200-day moving average, we'd like to think that you have good fundamentals behind you. That's what that 200-day moving average slope is telling you.
It establishes the trend.
That's correct.
There's trend, and then there's stochastic, which I call catching a knife in the dark. I think that was very good. What's the difference between trend charting and stochastic charting?
Stochastic is used in overbought, oversold sort of scenarios. The trouble with the reading of overbought is that there are 2 definitions of overbought. One could mean prepare for a corrective phase. The second could just mean that the item you're charting in that fashion is strong. The sort of real poetry or the real skill in this sort of thing is to try to figure out how you're using it, whether to prepare for a pullback or to just interpret that it means strength and going higher.
This is great. I mean, let's go back to this railroads higher chart. Look at that. And all those little ups and downs, you could have sold, enough, and it went flat there for a while. When do you know to go to a hold or to go to a sold when you've got a juggernaut like Union Pacific?
There are 2 things we use. We like to use the item and divide it by its 200-day moving average just to see how far above the 200-day moving average the item is on a percentage basis, and then compare that current reading to historical precedent. So if it's extended relative to its history, that will be an amber flashing sign. But we tend to give items the benefit of the doubt until they are moving below a downward sloping 200-day moving average. When that happens, we're selling, and we'll ask questions afterward.
Let's bring up our next chart, Rex, if you would. Chart number 6, mid-range for a decade. Look at that. There's the 90s and the S&P doing pretty good, and up we go, whether it's arithmetic or logarithmic. It looks great. What happened? I mean, we've gone nowhere in 10 years. How do you battle between a long-term nowhere, mid-range for a decade, or what you just saw with Union Pacific?
I think you continue to look and you try to find the things that are trending. You have to find the things that are trending and try not to let the market sort of color what is trending. items like Union Pacific or items like Deere or items like Caterpillar, those things are trending. Nike, McDonald's, Clorox, IBM is actually making a high above where it was in 1999. That's rather remarkable to us, given that the market, as represented by the S&P, has been sideways since 1998.
Do you use stop losses?
We do use stop losses. That's correct. We figure it's a good way to...
How do you establish it? First, define a stop loss.
Well, for example, if we're going to use $20 as our entry point, we'll use sort of a 7 or 8% move below 20 as our stop loss. And if we move below that 7 or 8%, we're out and we'll try again.
So you're out at 1860, and what's your target on 20 typically?
26.
26. Come over here, Matthew. Look at this, folks. This is how the pros do it. You set up a box just like this, and you're in at 20, and there's your stop loss, right? When do you cheat on your stop loss?
We don't cheat on our stop loss.
You get out.
You're done.
How many times are you successful? We had this article on Meredith Whitney the other day. I mean, you're right, like what, 30% of the time?
Sometimes if you're lucky and you're in a strong group, you can be right more. But if you keep your stop loss tight and you keep strict to your stop loss parameters, then you stay alive and you're able to hit home runs later on.
Thank you. Can you come by more often?
Thanks, Tom.
I mean, what are you, like one building away?
We're actually downtown.
Downtown. It's terrible. We got to have them by more often.